The markets are wild, but only to the upside, with the Fed making it very obvious that they will continue to print until it rains cash from the sky. Everyone from experienced investors to the shoe shine boy are now putting everything they have in. And for good reason. The Fed promised that they would never let it fall again. They care about us, right? I mean, this time is different, isn't it? You came here for the truth, so let me unveil that for you. Today we're going to look at where the money is going, the cash, the dollars. That's what you want to know. That's what I will provide you. We are going to look at the stock market, the ETFs, what's happening with passive investments. Then I want to show you the economic aspects. I need to get into how this affects regular people, average people that are simply going to their job, trying to make money, trying to put food on the table and keep a roof over their head. I've got information that you really need to see, so let's get into it right away. This is an interesting article, and there are several quotes that I want to just scroll through and show you how we have lived in this time frame where the euphoria is so maximized, and yet at the exact same time they're saying this time is different. There's no reason why the market could fall. Make sure you know that I do not make predictions about future events. That's not what I'm doing. I am simply pointing out how crazy, how unbalanced, and how wild and erratic the markets can actually be, and the reason behind it. And let me just be very clear. The reason behind it is the central banks. Now, just a couple quotes. Take a look at these. The market right now is clearly foaming at the mouth. All right, let's go down a little further. We are seeing the kind of craziness that I don't think has been in existence, certainly not in the US since the internet bubble. This is very reminiscent of what went on. Go down a little further. Party like it's 1999. It was beyond the realm of reasonable valuation. It's not as obvious a bubble as 20 years ago, but we're close to bubble territory. I have got to dabble and just see where this takes me. That's how many people, this is an average person, average speculator getting their money in, trying to get their feet wet, made a lot of money, so they're going to continue to do that. And we have seen many people following in the same path. And I completely understand why. The market's been going up. They don't want to be left out. And so they've been putting their money in. They don't know what they're investing in. They really don't know, but certainly their portfolio has grown. And right here, they're referencing the Federal Reserve. You have this grand maestro up in the front that's conducting the orchestra. And until they stop, the music is going to continue to play. I thought that was funny. And at the very end, all this stuff makes me nervous. But at the same time, I don't see why it stops. This doesn't feel like the top. We have heard this type of talk so many times before. Like I said, I don't know what's going to happen, but it's just very telling when you hear the rhetoric coming through like this. Record-shattering flows into stock ETFs leave bond funds in the dust. We have obviously seen the rise of passive investing, how much money has been put into ETFs. It has allowed individuals to invest in things that they normally would not have the skill to do. If you wanted to buy agriculture, for instance, many people aren't going to go and start buying the futures. They're not going to get into that market. They're not going to buy oil. They're not actually going to go in and invest in real oil. No, they buy an oil company, or they could buy it through an ETF. So the process here has changed dramatically. However, a lot of people actually don't understand what an ETF is. They think that they're actually buying into the stock market, but it isn't the case. Okay, there's much more with that. But anyway, unprecedented $81 billion poured into equity ETFs in November. And this has really been the case of optimism right now for the markets. That's what it's been, in fact, basically the whole year. It's all about optimism. Despite how bad the actual economy is doing, they just focus on what makes them happy. Equity exchange funds have overtaken their fixed income peers for inflows this year, thanks to November's epic stock rally. After lagging behind the bond funds, most of 2020 ETFs tracking equities lured a record $81 billion, their total haul for the year to $196 billion. This is really huge to see, and of course they're just suggesting here that investors are redeploying cash into stocks following a series of breakthroughs, and they believe that everything is going to be fine here in 2021. We'll see if that's the case. This is the chart that's associated with it. You can see the MSCI All Country World Index monthly change. You don't find this much money flowing in, that's for sure. So you can see the spikes along the way. There's always volatility, upside and downside. But right now, money, as I record this video, money has certainly been flowing in. That's November's numbers. And it doesn't surprise me whatsoever, because at this point, the Federal Reserve has made it clear what they want. About 95% of stock funds posted gains last month, with around 2/3 of them beating the S&P 500. Now you could see right here, this is the list, left-hand side are your tickers. All right, for all those who want to check that out, this is where the money has been going. The clear winner from the renewed appetite has been Vanguard Group, thanks to its lineup of low-cost products. The $189 billion Vanguard Total Stock Market ETF, VTI, is the ticker on that one, has seen the most inflows this year at $27 billion, followed by VOO, that's S&P 500 ETF, absorbing $26 billion. So you can go through the list in there. GLD is number 4 in the list, by the way, just to let you know. And QQQ just behind that. There's a lot of money that's been flowing in here. Part of this is because of what the Federal Reserve has been doing. I believe LQD is part of that, seeing the rise literally upon the announcement of their Federal Reserve's actions several months ago. That just saw major inflows, and that hasn't stopped. Look, a lot of people are just mirroring, like BlackRock, are just mirroring what the Federal Reserve has been doing. And to me, it's just not surprising whatsoever. We knew this was coming, and here we are. This is just some more detail. You can see 2020 on pace for a record year of ETF inflows. On the left-hand side, you see that. Of course, there's no surprise whatsoever, because ETFs, as you see in comparison on the right-hand side, have really become the new speculation vehicle, more passive than active by 2022. There was also some information I had seen previously that suggested we're already there today. It doesn't matter. As far as I'm concerned, it doesn't matter. That's where the money's going. Money's going more into passive investments. But if you look at the grandfather of passive investing, the guy who set it up in the first place, not necessarily the way it is today, but certainly the way that it was built initially, was to give the average person a way to get into the markets very easily, very cheaply. That's the whole point. You got the Vanguard funds that are very low cost, and they do things based on volume and so on. But even he had to say there is a huge problem when the bubble gets this big, when too much is going in and there's too much focus on one thing. You always have a problem on the way out. On the way out, that's when it's a problem. And this is the guy who basically started it all. So you don't have to take my word for any of it. Look at the guy who created it himself. Commodities to equities ratio right now, I mean, this chart goes back 1970 up until the present. We haven't seen anything like this before. That is huge. Nobody wants to invest in commodities today. And although we may see a spike up, they're certainly undervalued historically, at least when we compare it to equities. But what's going to happen? Will we see a spike in oil? What will happen with gold, industrial metals? If the economy picks up again, those will be in favor. So there's a lot that could certainly change here in the next year. This is the Commodities Index, just looking at how it's been heading down essentially over, these last years, since the financial crisis, in that whole run up throughout 2008, where everything seemed to be going crazy with commodities. And then we moved down and down and down. And the suggestion here from Crescat is that it will go higher, but I'm not making that claim. I'm simply showing you the information. Not surprisingly, you see these moving together: central banks, global central bank assets versus gold. And we have seen, as they print more money, the price of gold has increased, not necessarily in perfect linear fashion. You look at what's happening with the S&P 500 or any of the stock markets, these are obviously going to be correlated, not because it's worth any more, but simply because of the devaluation of the dollars. Look at it in any currency, and it really shows you what's been going on. If you found it informative, hit that thumbs up button. Simply by clicking a button on your screen, you help to support the channel. Thank you very much. If you want to learn about e-commerce, you want to build a business online, or you just want to make some cash, it's all available for free right here in my course, the AmazonGPS.com. And if you want to know about the financial system, you want to understand central banks, you want to be able to ask the right questions, maybe teach your family, your friends, or you want them to learn and you simply want to hand them a book, these are the two that you need to check out. You can see them in the link in the description, or if you want the audiobook instead, themoneygps.com. Wait a second, don't go anywhere. This video right here, I gave so many good strategies, information that people need to see about how to actually help themselves, help their families and friends. And it was a terribly performing video, as I expected it would be. Definitely watch it. Click on it. I'll see you there.